You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music must mean one thing. It is Education Wednesday. Time for Options Bootcamp, the premier educational program for all of you out there. Maybe you're new to the world of options. You want to dip your toes into those waters. Maybe you've been treading a little bit of water. You want to go a little bit deeper. Maybe you went too deep. You're a little bit spooked. You want to dial back. Hey, we got you covered. We'll be your lifeguards here on Options Bootcamp. My name is Mark Longo from theoptionsinsider.com. As well as, of course, from the ever interesting, ever insightful, at least we hope so, Options Insider Radio Network. Reminding you, if you're just listening to Boot Camp, we see it all the time. We have people writing into all these other shows all the time. Hey, I discovered you guys through Boot Camp, and now I'm listening to Option Blog or Ball Views or Twifo, whatever the case may be. I'm expanding my options horizon. So if you're just listening to Boot Camp, you're missing out on a whole bunch of other stuff. Maybe you like volatility. We have a whole show about that. Maybe you like more active and engaged kind of stuff for daily trading for the retail folks. Option Block twice a week. Maybe you like futures option. I'll learn about commodities and things. We got Twifo for that, of course. Crypto, the hot things going on in crypto land. We got that. We got shows for asset managers and advisors. What should your advisor be bringing to the table from an options perspective? We got a whole show about that and a whole bunch more. So if you just listen to Boot Camp, make sure you upgrade. You're also missing out, if you just listen to Boot Camp, you're missing out on the other half of Education Wednesday, which is Options Playbook Radio, which is already live on the network feed. Went live early today, so you already got that in your hot little hands if you're listening to this show. So if you just want a double dose of education, just Playbook Radio and Boot Camp, you should subscribe to the network because you're missing out on a lot of education if you're just getting the old Options Bootcamp. Of course, keep those questions and comments coming too. We do love to hear from all of you guys and gals out there. Let's see who we're hearing from on the old program today. I am pleased to be joined once again by the black-hatted one himself, a.k.a. the de facto mayor of Frankfort, Illinois. He is none other than Mr. Dan Passarelli, the founder of Market Taker Mentoring and the author of one or two options-oriented tomes when he's not busy doing his mayor stuff. Mr. Mayor, welcome back to the program, sir.
Oh, man, good to be back. Nobody wants me to be the mayor, believe me.
Your first act as mayor would be to reopen the Charlie Horse, would it not?
That's right.
The one and only restaurant they had in that one horse town of Frankfort, Illinois. And it's gone, listeners. So Dan's trying to bring it back. And we're trying to answer more of your questions. We got so many of them. We got some good ones. We had a fun topic we discussed recently on the show about stock repair spreads and perhaps doing a little bit of a new flavor on them. We'll get to that in a second. But first, Mr. Dan, it's been a little bit since you and I chatted. A lot going on in the markets. We saw aggressive vol annihilation all the way down to the 16 handle. Some measures like spikes got into the 15 handle very briefly. Then we saw what we typically see these days. We saw a bit of a sell-off, a bit of a vol reversion back up to the high. It looks like VIX got up about 19 and a half or so in that range, coming back down the other side now into the 17 range, where we have seen a lot of topsy-turviness. Markets have been rally-ho most of the time. Of course, a little bit of red on the screen, but still, I say that, but we're still at 4160 odd in the S&P. So we're still nearly 200 points above the 4,000 level, which everyone was worried about a while ago. Could we possibly close above it? We're still well above it. So even though we had some sell-offs this week, we're still looking pretty lofty. So all that a long way around to saying, what is going on? What is top of mind for the folks over there at MTM and for yourself in these crazy times in the market, sir?
Mark, we've been watching, the market and VIX, just like we're talking about here. And also the VVIX, because it's been pretty interesting. The VVIX has risen for about 2 weeks in a row overall. Today's a little bit of a down day there, but that sort of predicted a little bit of the rise in the VIX, and it really popped when the VIX was rising the last couple of days and when the market was falling. And so, I don't know, just kind of watching this pullback here. We'll see if that's a temporary blip. I feel like if the VVIX rises a little bit more, I feel like that's a little bit of a bearish signal here, but we shall see.
Of course, bearish is all relative. I see people wringing their hands, Dan, and we're still almost 200 points north of 4,000 in the S&P. So we got a ways to go before we're talking real bearish activity here. I mean, just think about it. When we were on the election special back in November, we were talking about the S&P vacillating between 3,200 and 3,300 that night. Mm-hmm. We're almost 1,000 points north of that. So people who are wringing their hands about bearish activity, we got a long ways to go before we're even back where we were back in election night. But let's dive right into our topic for today. We talked last time on the show about stock repair. It seemed like a good time to do a refresher on that. And then, of course, perhaps add a bit of a twist, a bit of a new flavor to it. So without further ado, it's time for some options drills.
Well, in boots, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes,
sir! All right, everybody, welcome to Options Drills portion of the show, where we take a strategy, break it down in a little bit more detail, maybe add a few new wrinkles to it like we're going to do today. But it's been a little while since we've talked about your good old friend, the stock repair. I know a lot of you have probably joined our show since the last time we've talked about it. So let's start with a bit of a refresher. What the heck is stock repair? What are we talking about when we're doing stock repair? Well, let's start with everyone's favorite underlying, XYZ. We've all made or lost fortunes in XYZ. In this case, unfortunately, we're going to lose a fortune, at least for a little bit. So let's say you bought XYZ at 100. And now, unfortunately, at the time of our show here, XYZ has been cut pretty much in half. It's down to $50. It's, whoa, that's an annihilation. That's pretty rough. What are you going to do now? Well, you have a couple of choices. You can do the crypto route. You can hodl. You can hold on for dear life. Hope the stock makes it all the way back to 100, at which case you'll have broken even. So stock has to double just for you to break even. That's a pretty rough thing to expect from any underlying in a realistic time frame, really. That's your one choice. You sit there. It becomes the quote-unquote long-term holding like people like to stick in their portfolios. You ever notice that when people take a hit on their stock, all of a sudden, oh, it's a long-term holding now. Well, in this case, it could be a very long-term holding. You could close the position. Your second choice is just close the position, get the heck out of Dodge, take your hit, move on to another trade. Or your third option, pun intended, is you can do a stock repair trade. Now, let's say you think the stock can retrace a bit, but it might be a little bit much to ask for it to go all the way back to 100 again. So let's say in our case, you think the stock has a pretty reasonable chance of getting back up to 75 in the near future. Now, you say, that's not bad. I get half of my money back. What if I told you there's a way you could do that and get pretty much all your money back, get back to break even? Well, you can. and it's called the stock repair trade. So in our strategy here, what are you going to do? You're at 50 now in XYZ. You think it's going to get to 75. Let's just say you've got, I don't know, 3 months, 6 months, whatever your time frame is. The time frame isn't important. It's more about the strike selection and how you set it up. You already have the stock. Remember, a stock's at 50, so you already own the stock. On top of the stock, what are you going to do? You're going to buy one at the money call. In this case, the 50 call. You can play with that strike a little bit. You can go a little bit out of the money, a little bit in the money. Usually it's at the money strikes that people use there. So you buy the 50 call. Now you're going to turn around. You think you can make it to 75. So you're going to sell 2 of the 75 calls. Now, what does that do? First off, selling 2, in this case, it's going to be a pretty wide spread. So you're not going to get a ton for the second leg out there, but it's going to get you a little bit more credit, obviously. So first off, you're going to pay less for that at the money call than you would have paid outright. So that means your outlay is going to be a little bit less. And then B, now let's say the stock starts to rally and it gets all the way up to 75. Now what happens? You have effectively a long stock position plus a long ratio call spread. So you're long 1 call at the 50 strike, short 2 at the 75 strike. We have effectively the long stock, which of course is going to make $25. So you made $25 on that stock position. So that's nice. That's half of your money that you needed there. Of course, you also have a long 1x2 call spread now. So you have a call spread that you bought at the 50 strike, and then you sold 2 calls at the 75 strike. You might say, well, I don't want to be short units. You always talk about don't be short units. You're not. Remember, you have the stock as well. So now you get to 75, and now you hit your covered call strike. So that call spread that you bought is now worth $25. So you have effectively your $25 you made back for that call spread. So that call spread made $25 or close to it now. And then you also made $25 on your stock. The call spread 1 by 1, so that's pretty much done. And the extra call that you sold, your stock that you own will get called away there as well. So you're covered effectively on both short call legs. And so now the stock has only rallied back up 50%, and yet you've made back all of your money. And that's what we mean by a stock repair spread. You could play with it, the strikes, the duration, all different types of things. But that's the very basic structure of a stock repair type trade. You're going to have an underlying position, and you're going to have some sort of ratio vertical spread with it as well. So there we go. Table setting, refresher on stock repair. You can go back into the archive, check out some more episodes we've done a little bit longer on stock repair as well. So now we get into that. Dan, you mentioned you have a new flavor on that. Let's get to that in a second. First, give us your thoughts, and maybe do you have a standard way you like to utilize the stock repair? And then you kind of teased us last week with your super duper new cool wrinkle on stock repair. So regale us with that, sir. What is the new MTM Passarelli stock repair strategy flavor, sir?
Yeah, Mark. So I typically have described it traditionally in the past to my students in a similar way to how you did. I mean, a couple of little nuanced different things, but the key element in the way that you described it, in the way that I always have, is basically, look, you put it on now and you hold the darn thing until expiration, because that's the only way it works. Because the delta of that spread is very, very small, and it doesn't really change much until you get close to expiration. It's like, you don't really make a lot on it. And then I came to realize that we can take a little bit of a more active approach. You can actually do some adjustments with these stock repair trades. Because, look, the biggest problem that I've noticed in the past is if I put the stock repair strategy on today and there's 3 months until expiration, if the stock goes up to my target in 2 weeks, then what do? I twiddle my thumbs and hope it sits there for the next 2.5 months. But you don't actually have to. You can then do an adjustment, take in a small, teeny, tiny bit of that profit, maybe just on part of the position. It depends on how much time has passed, and just simply roll it to higher strikes. Probably, if enough time passed where you can buy back the short options for roughly what you paid for them or better, then you would just buy back the short options and roll them up to a higher strike to give yourself a little bit more what we like to call wiggle room. And it can be a little bit more actively managed, and there's a little bit more flexibility than I'd always thought about it and that I'd always taught it. It's a really great strategy. I've got one of them on right now, as a matter of fact.
Good stuff, Mr. P. I know our audience, their gears are probably already turning with how they could use this in their own portfolios. Let's just clarify it for them one more time. If they're out there, they're thinking, how do I do this new and improved Passarelli flavor of stock improvement? What is the trigger? When should they know? When should the adjustment kick in? And they should start considering rolling their position rather than letting their stock get called away.
If you reach the target price early, that is what triggers the adjustment. Because you kind of have to take some sort of action at that time. Otherwise, you're just sitting there twiddling your thumbs in a terrible situation of hoping that the stock just sits there, which is kind of that's sort of an anti-strategy.
An anti-strategy. I like that. That's not a strategy. That's an anti-strategy. Yeah, this is one of these great strategies that a lot of people who are new to options don't know of. It's very straightforward and it's very useful. There's a lot of people who have, maybe not right now because everything just goes up, but outside of these scenarios of right now, usually everyone's got a couple of losers sitting there in their portfolio that they don't really know what to do with. This is one way. Now, remember, if your outlook is that the stock's not going to go much north of 50 anytime in the near future, this strategy is not going to save you. It's not going to turn a crappy trade miraculously into a better trade. You got to cut your losses and move on to the next trade. This is really only for a scenario where you see some sort of near-term retracement and you think you could take advantage of that to make back your money on the trade. We kind of gave you an extreme example here, going from 50 back to 100, or in this case, 75. It doesn't have, usually isn't that wide of a chasm, but we tried to make it easy for folks to wrap their heads around. So again, stock repair, you have a stock position, stock sells off some percentage, you turn around, think it can rally, maybe not all the way back to where you bought it, but some reasonable level in between. In addition to your stock, you buy a vertical call spread, buy one, sell two at a strike somewhere in the middle there where you think it makes sense and is reasonable for the stock to go. And hopefully if the stock makes it that far, now, of course, you have effectively made back your money. It's typically viewed as a set it and forget it type strategy, but you can get a little bit more active when you hit your strike. Now, of course, like you said, you can roll that and adjust that and give yourself a little bit more upside there on the stock repair. So it's an interesting strategy, a lot of different flavors, a lot of ways you can do it. Maybe you have your own personal favorite flavor of stock repair. Hit us up. Let us know. Maybe you have questions about how to set it up, particular underlying you think may be useful for it. Hit us up. Let us know. But it's an interesting time. Learn about this. Keep it in your back pocket. You may not need to do it right now, but there will come a time in your trading life where you will have a scenario like this. And you'll be happy that you know about the stock repair strategy. And we're always happy that we know about your questions. So let's get a little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call, the portion of the show where you guys take the reins, your questions, your comments, your insights, your pearls of wisdom. You guys, as always, have lots of questions for us. Before we get to that, Mr. P, things are always popping off over there in the land of MTM. Folks are always coming to you with some interesting, sometimes out of left field questions. So what are some of the interesting questions that have come across your plate there in our MTM question of the week, sir?
Well, one of the questions is on short squeezes, like how do we know when one is going to happen? Because there's a lot of people who've been trying to play these and they're tough. Going and buying a stock and holding on to it, waiting for a short squeeze to one day happen, whether it's tomorrow or 5 years from now, when there's somebody really smart out there who's managing a whole ton of money, is short a ton of it. It's kind of a weird play. So how do you know when one of these might hit? So first of all, I've been developing a system that soon I'm going to be able to share with some of our students that gives us a pretty good indication. But now one thing to know about them for sure is that most of the plays are not going to work out, which at first seems like, oh, well, then it's a terrible strategy. But no, there's plenty of people, talk about like Nicholas Nassim Taleb, who wrote The Black Swan, who have had strategies where, they're okay losing 90-some% of the time.
Wait, are you telling me the Doge short squeeze is not going to work out, sir? I should take my kid's college fund out of that one right now?
Well, it could, it could, but here's the thing. Like there's a couple of things going on here. First of all, if you manage your risk and you cut your losses quick and then take the lion's share of the profits on the short squeezes, even if you do only win 1 out of 10, that can be a good business model. Putting all your money into one short squeeze and hoping it works out is a terrible idea. But coming up with a pretty good system or following a good system that somebody else came up with and doing it over and over again might actually be able to work out great. So there's a couple of things to watch. First of all, you've got to identify that there is short interest and how much there is. A lot of the times, the bigger the better. But you also have to identify, is this a solid company? Because if somebody's shorting a bunch of it, the company might suck. Like they believe that it's extremely overvalued and should be trading at a lower price, and they might be right. So you want to get a handle on that. And you also want to look at the implied volatility of the calls and its sensitivity to the stock rising. If when the stock rises, the implied volatility of the out of the money calls goes up, that could be an indication that there's some short squeezers watching that and jumping on, and that momentum could catch on.
Yes, the good old short squeeze, the value of call skew and all the goodness there. And if you have questions about any of that kind of stuff, check out, of course, the archives of this program. We've gotten into call skew and implied volatility many times in the past, and given the environment we're in right now, probably won't be the last time we talk about that topic here on the show. Let's get some mail here. Dan, first off, we got Jason Cruz says he was listening to our recent episode. He said, just listen to OBC credit versus debit spreads. I had a feeling this show was going to come back again, Dan. People have lots of thoughts on this. He said, just listen to that episode. If spreads are wide and silly, you don't have to close the credit spread. So you only pay the market makers once versus twice. Okay, so he's weighing back in on the whole debit versus credit spread debate we had going here on the show. People wrote in saying that they thought there was a higher probability of credit spreads versus debit spreads. We kind of debunked that because, again, we're talking about effectively a box. We're talking about the same strikes on both sides. So you're not talking about an out-of-the-money credit spread versus an out-of-the-money debit spread, which I think is the way most people were talking about. So we've already debunked that. We said you're kind of doing the same thing. He's writing in back in favor of the credit spread, Dan, saying if the spreads get wide, so if the spread's in the money, he says you don't have to close the credit spread. So at the end of the day, you only pay the market makers once, as opposed to the debit spread. Obviously, you have to sell it out to really collect your money there. So it's an interesting outlook. I like it. What are your thoughts here on Jason's writing back in to defend the credit spread over the debit spread, sir?
About 1 out of every 100 trades I hold until expiration. And when I do, I have a very specific reason for it. It's almost always a terrible idea to hold an option all the way until expiration. And I say that because at some point, the risk reward just becomes no longer worth it. Like imagine you sell a 2-week credit spread for $1.25 and it's called a credit spread. The stock goes down a little bit, a week passes, and now you can buy it back at a nickel. Okay, you're crazy if you sit around and wait a week to get that extra nickel when you can lock in $1.45, 97% profit. Like it makes 100% no sense. 100% of the time, it makes no sense. So, I just don't like that on the premise of risk management, Jason. I'm not trying to beat you up or anything here, but I feel like this is an extremely important lesson. Geez, man. I mean, I could give you 100 personal stories of before I learned this lesson down on the trading floor, of how I lost money by thinking, those out of the money options, they're so far out of the money, they're going to stay out of the money. I'm not going to worry about it. And then all of a sudden, 3 days later, some crazy news comes out and you were sitting there on a gigantically great profit. And now it turned into 10 times as big of a loss. So I am a big fan of always closing out before expiration. Was I decisive enough on that?
That was very decisive, yes. So people are still writing in. They still want to defend that credit spread. They really want it. Yeah, I'm with you. That's such an outlier scenario, right? To justify doing credit spreads every time for that one aberrant scenario. It's not really worth it, Jason, even though I appreciate your steadfast and stalwart defense of the credit spreads. All right, we got Mr. Unlimited in the chat. He's chiming in what I was just saying. He says, don't worry, Mark. I'm sure Harvard and Yale will still accept Doge. Yeah, who knows? By the time my little guy goes to college, who knows what cryptocurrency will be the hot one, the rage out there. I got a feeling it probably won't be Doge, but hey, who knows? Crazier things have happened. So it sounds like I should take the kids' college fund out of Doge. Okay. Message received. I will do so after the show. All right. Next up, we've got Denise Ferrara writing in, says, I'm brand new to options. I'd love to listen to your show from the beginning. Sadly, your podcast begins at episode 33 on Apple. How do I gain access to your first 32 podcasts? If they're gone forever, where do you recommend I begin? Thank you, Denise. Yeah, you're not alone, Denise. First off, welcome to the show. You're not alone. We've had a lot of new listeners come in over the course of the past year, and indeed, of course, even the past few months. And a lot of them have the exact same question. We've answered this many times here. Apple, like we said, limits you to how many episodes they're going to display. That's usually fine for most podcasts. But of course, our podcasts and our network, kind of epic. They go back a ways. Our network goes back to the pre-iPhone days of 2007. There was no iPhone when we launched this. iTunes was kind of barely a glimmer in Steve Jobs' eye at the time. So you had to have an RSS feed. It was all kinds of crazy. But Boot Camp goes back a pretty good ways as well, over 100 episodes. So clearly well beyond the display limit of Apple. So what you need to do, I've said this before, I will say it again, 2 best places to get all of the archives for all of our shows, not just Boot Camp, but everything we do. Our website, of course, theoptionsinsider.com. We revamped it a couple of years ago to make it even easier, made the shows even more front and center. You go to the homepage, you see all the shows there, you click on whatever show you want. You can get a full archive going all the way back to the beginning of every episode. You can download it, you can stream it. You also have links there to subscribe on all the major podcast platforms. You can check out other platforms. Apple's not the only game in town. I mean, I like to use Pocket Cast myself, but to each their own. I'm an Android guy. There's Podbean, there's Spotify, there's whatever. You can also go into any app store, the Apple App Store, the Google Play App Store, even the Kindle Fire App Store, and just search for our app. It's called the Options Insider Radio Network mobile app. It's a big, beefy name, I know. Just search for our name. You'll find it in the App Store. And that will also get you access to every single episode that we've ever done of every show here. So if you want to go out to the full archive of Boot Camp, those are the 2 best places. It's hit or miss. Every other outlet has kind of their own limits on how many they will display. If you want the full archive of everything we've ever done, theoptionsinsider.com and our mobile app are the 2 best places to get it done. All right, and speaking of getting her done, this episode is done. We'll be back, of course, don't worry. Back next week, talking a lot more fun options, shenanigans out there. If you folks have more questions, clearly you do, keep hitting us up, keep rating and reviewing as well. It really does help new folks like Denise and everyone else keep discovering the program. Remember, if you want all the full archives, the website, the mobile app, the 2 best places to go. And Mr. P, if they want to check out some options-oriented tomes or perhaps attend a virtual summer retreat, where should they go? What should they do?
Well, Mark, it's funny you should ask because we happen to be having a virtual summer retreat, and you can learn about it by going to markettaker.com/summit. Market, like stock market, taker, like take what is rightfully yours, 2 T's in a row, markettaker.com/summit. And this is actually, we've done these retreats in person for a number of years, and this actually ends up being our biggest one and probably our best one because we've got a whole bunch of special stuff planned. So, yeah, come and check it out. We'd love to have you attend. We've got actually a crazy early bird discount going on, too, for those who are fast action takers.
There you go. MarketTaker.com, the place to go to begin your journey. Who knew? You go virtual, you go big. See, there you go. Check it out for yourselves over there at Market Taker. On behalf of myself and Mr. P, I want to thank all of you out there for downloading, streaming, subscribing, for listening live, for sending in such great questions, for rating and reviewing us on whatever platform you get it. Keep it coming, and we'll see you back here throughout the week. Remember, there's a lot more on the network. There's TWIFO tomorrow. There's episode 2 of the Option Block. Friday Vol Views. all the way through next week, a whole bunch more shows, to another Education Wednesday and another episode of Options Bootcamp.
This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.